Hey everyone, if you want to save yourself 2 hours of listening to a really dry corporate earnings call, you are in the exact right place. Today we are breaking down On Holding's massive Q1 earnings report, and I'm going to show you exactly how they absolutely crushed Wall Street expectations, how they're wielding some incredible hidden pricing power, and why analysts are literally scrambling to upgrade their future targets right now. Seriously, this isn't just a story about selling running shoes, it is a masterclass in operations and scaling.
So let's just put the bottom line up front right away. On Holding didn't just meet their earnings expectations, they delivered a massive 34% earnings beat. 34%! And because of that hidden pricing power, plus some really wild new manufacturing tech we're going to dive into, management actually raised their entire 2026 financial guidance. For us as investors, that is a massive signal of confidence from the executive team. They are practically shouting to the market that their growth story is not only intact, it's actually accelerating.
Here is a quick roadmap for today's explainer so you know exactly what we're covering. We're going to start with those Q1 numbers, break down their global growth and channels, uncover the secrets behind their massive margin expansion, look at their innovation pipeline like light spray, and finally, unpack that upgraded 2026 financial outlook.
Okay, let's dive into this first section and look at the massive gap between Wall Street's expectations and reality for Q1. Just look at that number, plus 34%. On Holding's Q1 net profit hit 100 million Swiss francs, which translates to about 0.31 francs per share. This completely blew past the market consensus by a staggering 34%. And their top-line revenue? That was up 15% year-over-year, hitting 830 million Swiss francs. You know, this wasn't just a minor beat. It was a comprehensive blowout driven by a rapidly expanding global consumer base. Seeing top and bottom line beats of this magnitude suggests the company is operating at absolute peak efficiency.
And this right here perfectly illustrates why that revenue growth is so incredibly healthy. Their inventory turnover shrank down to just 125 days this quarter. Compare that to their 5-year historical average of 158 days. This metric has actually been tightening for 9 consecutive quarters now, which basically proves that global consumer demand for On's products is running extremely hot. They are essentially selling inventory almost as fast as it hits the warehouse. And for the business, that means less risk of product markdowns and incredibly healthy cash flows.
So, you might be wondering, where exactly is all this demand coming from? Let's transition over to our global growth and channels breakdown to see how this 830 million franc revenue pie is being sliced up geographically. The regional breakdown reveals a really fascinating growth story. The Asia-Pacific region, or APAC, currently makes up 21% of revenue, but get this, it grew a massive 44% year-over-year, driven heavily by huge momentum in China and South Korea. Europe, the Middle East, and Africa, EMEA, sits at 25% and grew a very strong 23%, especially in the UK and Germany. But we've got to talk about the giant piece of the pie, North America at 54%. While the headline growth looked a bit slower there, when you adjust for constant currency, North America is still growing at a stellar 17%. Their global footprint is expanding beautifully across entirely different cultures. Now, if we slice that exact same revenue by sales channel, we see wholesale at 61% and direct-to-consumer, or DTC, at 39%. DTC grew a solid 16% year-over-year, and management noted a surging demographic here. The 18 to 24-year-old segment is accelerating fast. But here is the really massive upside for the wholesale business. On is currently only in about 50% of the retail doors for key partners like Dick's Sporting Goods, Foot Locker, and JD Sports. That leaves an immense runway for physical store expansion in the coming years. Oh, and fun fact, their Cloud Tilt shoe was actually the #1 seller at Foot Locker Europe in March. That kind of retail momentum gives them massive leverage. Selling more shoes is great, obviously, but keeping more of that money as profit? That's even better. Let's move into our next section, the margin expansion secrets, and look at exactly how their gross margin skyrocketed to 64.2% and their operating margin hit a highly profitable 14.1%. Now, what's really interesting about this slide is how surgical On Holding was in building this profitability. Their gross margin expanded by a massive 4.3% year-over-year. So how'd they do it? Well, supply chain improvements added 2.5%. Their strict full-price sales strategy, meaning they rarely rely on discounts, added 1.5%. Favorable foreign exchange added another 1%. And what's truly remarkable here is that they achieved the stellar growth despite facing a 1% drag from US tariffs. That shows some incredible operational resilience. And right here is the ultimate proof of a premium brand's strength, hidden pricing power. Since 2023,
On Holding has successfully raised their footwear average selling price from around $145 a pair to over $170 today. Consumers are willingly paying a premium for the brand, which is exactly what fuels that full-price sales strategy we just talked about. In an environment where so many retailers are forced into deep promotional discounting just to move product off the shelves, On Holding is commanding higher prices and actually gaining market share.
Speaking of premium value, I want to make sure you are getting the absolute highest quality investment insights. If you want to stay updated on the latest U.S. stock market news, make sure to subscribe to my channel. I upload new explainers every week, cutting through all the noise to give you exactly what you need to know.
Okay, let's shift our focus now to the technological product pipeline, because this is the engine that is truly justifying Wall Street's forward-looking optimism for the stock. 30 times. That is not a typo, that is the production scale jump happening right now. On's newly opened automated facility in Busan, South Korea is scaling their revolutionary light spray shoe capacity by a factor of 30. They're jumping from producing just a few thousand pairs a year to hundreds of thousands of pairs annually. Their new light spray Cloud Monster Hyper shoes are already seeing massive demand across APAC and the US markets. When you can scale proprietary manufacturing tech that quickly, it completely changes the unit economics of the entire business.
And the innovation isn't just happening in manufacturing. Look at these product demand highlights. Apparel revenue is absolutely exploding, up 45% year over year. They are aggressively capturing the female demographic with new proprietary tech like SenseTech for a weightless feel and an upcoming autumn release called FormTech for enhanced shape retention in leggings. Over in footwear, they're launching a new Surreal Superfoam that's getting rave reviews from runners, and the new Cloudrunner Max has immense demand. In fact, orders from specialized running gear partners are up over 25% year over year. They are building a deeply diversified product ecosystem.
So, the crucial point is how all of this operational excellence and product innovation translates into future shareholder value. Let's look at the grand finale of this explainer, management's upgraded 2026 financial outlook.
These upgraded targets are exactly why analysts are scrambling to update their models. Management significantly raised their long-term profit targets. Previous 2026 gross margin guidance was 63%. Now it's projected to be greater than 64.5%. That flows right down to the bottom line, with EBITDA margin targets jumping from a max of 19% up to a range of 19.5% to 20%. And here is the kicker. Management baked in a very conservative assumption here. This upgraded guidance assumes a steady 20% U.S. tariff on Vietnam imports without any potential tax refunds. So if those tariffs ease up at all, there's even more upside potential built into these numbers.
And on top of those incredible profit margins, they are targeting at least 23% constant currency revenue growth for 2026. This explosive top-line growth is going to be driven primarily by their highly profitable direct-to-consumer channels, continued aggressive expansion in the Asia-Pacific region, and that fast-growing apparel segment we just looked at. They have literally built a multi-engine growth machine.
Well, that brings us to our final takeaway, and I really want to hear your thoughts down in the comments section. Number 1, will On Holding's premium pricing strategy, pushing that average selling price over $170, actually hold up if global consumer spending tightens? And number 2, which U.S. stock or company earnings would you like to learn about next? Let me know below. Thank you so much for joining me for this explainer. I really hope it saved you some time and brought you some real value, and I'll see you in the next one.